Hey everybody, welcome back. Happy Tuesday. Hope you guys are having an awesome day. Market's a little bit bouncy today. We're going to get into this. I have had an awesome family weekend celebrating Canadian Thanksgiving over the last couple of days. So that has been great. Been able to hang out with some family, got to see my nieces play in the pool. The weather here has been spectacular. And trading has been all right over the last couple of days, which has been nice as well. And let's get into this. You know, I don't like to mess around too much. If you guys have questions, please ask in the chat. I'm talking about options today. Obviously, I'll talk about any sort of anything you want to talk about. And please let me know that this is working, because I run this as a solo show. So if somebody could just chime in and say, yeah, everything's a go, that always helps me a ton. But more importantly, let's look at some different stocks. So one of the questions from one of my patrons was about 3M. Now, 3M is a company that I haven't touched in a while, actually. And yeah, wow, way down. You know, it's always good to kind of have a fresh look at these charts. 3M actually was one of my big option plays that when I was learning how to trade options went against me way back when it was a much smaller stock, way back here. So I've been trading 3M and other companies for the last over almost a decade now in options. And it's been kind of fun. There used to be a lot of premium in it, and you can see right now stock is trading down at 110. And if we look back in history, like it was back in 2013 when we were at these levels before. So this is an extremely good deal if you're looking at it from a price point. And let's dig into this a little bit further and look at some of the financial data on 3M. So first of all, I'm going to go over to Seeking Alpha. I love Seeking Alpha. It is an amazing resource. One of the things that I love about it is at a glance, as I log in here, thanks Aaron for letting me know that everything's great. When I look over at this part of the screen, I can see this rating summary. So I can see what the authors are rating. I can see what Wall Street rating, and more importantly, this is quantitative analysis. And the computers are getting smarter and smarter about what stocks are going to do well. So we can see that there's a hold rating. And a lot of these companies that are in the market right now that have been around for a long time have this hold rating on them. And one of the reasons for that is because they're often still profitable. It's just that their growth is stagnated and their momentum has been poor, because the last couple of months the market has been downtrending. You know, we're quite firmly in a bear market, and more and more I am seeing this kind of quantitative rating that is a hold. So I can look back in time and I can actually see what the rating was for 3M over the last year, and I can see that on a daily basis. I can see whether or not the growth was good. And you know, the big thing that I'm always looking for in new investments is whether or not the company is profitable, because that is a massive concern right now with the rising interest rates. So no other questions, but you guys, so I'm going to continue on 3M, but please ask away, because it can get busy in here and I like to get to everybody's questions. So the sooner you ask, the more likely it is that I'm going to cover it. One of the things that 3M does is it does pay a dividend. So you can see here there's relatively safe. It's got some growth. It's got a decent yield, and obviously consistent. I mean, they've been paying it for a huge amount of time. Their dividend payout right now, they're actually the payout ratio is a little bit higher than I would have expected. Looking at this, at 60%. So this is the amount of money that they pay out relative to their income. But their yield is also quite high, and this is part of the reason for that is because they increase their dividend all the time, and it's irrelevant to the payout, which is in dollars, to how. What am I trying to say here? Well, the payout on dividends is in dollars. So when the stock price drops and we see the stock price come down and down and down, what that means is that the yield automatically goes up. So right now, investing today, for every $110 worth of 3M that I would hold in my account, which currently I don't hold any, but if I was, I would actually get a 5.5% yield on my money over the next year, because my expectation is that I would collect a 5.96 dollars in dividend over the course of the next year. We can see that it pays quarterly. $1.49 was the last payout date. So that's kind of how that works. It's a quarterly frequency. And when I'm looking at stocks, and as you guys know, I was a dividend investor for a long time, and is why 3M was one of the stocks that I started to trade options with. This dividend yield becomes important because if I'm in my account, I actually want to hold shares. So when I'm building strategies, I usually build it around actually purchasing shares and holding them in my account so that I can benefit from this yield. I have to be concerned about short calls when I'm trading something that has a dividend, and I don't want to hold short shares because I would have to pay the dividend out of pocket. So let's take a look at interactive brokers and just pull up the option chain and see what we can pull up on 3M. So I'm gonna just type that into the top of the chain here, and that's gonna populate for a second. And while we're doing that, why do we have no data here? It's no good. I've got no data at all. Let me restart this for you guys. I will restart that and see if that will load something, because that is no good at all. In the meantime, we'll take a look at this chart and we'll just see if it's at the bottom of its Bollinger Bands. So this is a good time. If there's strategies that I would love to have some more specific conversations about strategies in particular, because I think that there's a time where we, in this bear market, it's like, when we're deploying something like, say, a short put, is it advantageous to us to add, say, a short call or a call spread? And I personally believe that it is. I like to not play single-sided in this market because we really don't know when this rebound is going to happen. I'm expecting a rebound long term, but in the short duration, it's like in the next 2 to 6 months, we could continue to see a bear market. And so just give me one moment. I'm going to turn on IBKR here for 1 second. All right, thanks for that. Just had to concentrate for a second there. So Andrew's asking about Visa. At what level would you start selling covered calls again? And Andrew is correct. I am not currently selling covered calls against my Visa positions. And Chris is asking, what typical bear setups for this market are you using? I can definitely show you that. Andrew's also saying, go to help data connections. Oh, and reconnect. Okay, I just restarted. And it looks like it is working, but thank you for that. So here we go, 3M, let's take this in and let's look at I'll set up a position that I like to use in this market because I do see downside risk in this market still. So if we look at the chart, if we look at this chart here on TradingView, you can see what's happened is that we're actually seeing, let me just zoom in here a little bit for you guys. What's happening is that we're looking at the bottom of this Bollinger, but this upper Bollinger Band is actually collapsing a little bit. See, in the past, we had some expansion and now everything is kind of downtrending. So in this type of environment where my expectation is that long-term 3M could go up, but in the short duration, I actually am worried about it going down. What I would want to do is I would want to do a neutral trade, and I would, ideally have some sort of parameters set that were, in a range like this. And what I might do is I might target this area down here to have a bigger profit zone, have a larger profit spike. So I'll show you a little trade. This is actually a yet unnamed trade. I do have a post on my YouTube, and it's one of the things that we've been doing regularly enough that I've actually added it to my spreadsheets, which are available over at my on my website, Drawbridge Finance. But if you want to vote on the name, the current runner-up right now, or another runner-up, the current leader is actually called a Scorpion. So it's kind of fun. And it's always fun to name trades. And one of the reasons we do that is because it just makes it easier for us to take a look and say, okay, well, we know what the parameters of a particular trade are. So in this case, what it is it's a put ratio spread to the downside and then a naked call to the upside. So what I can do is I can go out, say like 30 days, and I might decide that I want to sell a couple of the 100 puts. Now, very easy to do a strangle on a stock like this. I can set up a neutral strangle. I can do the 16. This would be slightly delta positive. So you see the combined delta here. We're looking at negative 20 delta on the put and a positive 17 delta on the call, giving us a positive 0.3 delta. So that means it's very, very slightly bullish, but almost neutral. And if we look at the profit profile, you can see the break evens between 97 and 124. The reason I did that first is because I wanted to just kind of pull this up and take a look at where we are here on this chart and how wide I went. And I went extremely generous, as I can see here, $80 down here at this long line and 137. Now, obviously, the options market is not showing that much movement in here. The 30-day expectation for that 17 delta was the 120, right? Is that what we chose? 122 and 100. So let's just mark those on there. So there's an 80% chance, I'm going to change the color here for you, and there's an 80% chance that the stock is going to be trading at 122. And there is also, 83% chance that it's going to stay below that, and then an 80% chance that it's going to stay below or above 100. So that's what the current market is showing us right now, is that the stock from here is going to stay within this range, and we have a pretty good likelihood of that happening. Now, what I want to do is I want to set up a trade that makes some money if it does go down closer to this 100 level. So let's take a look at that. So I'm just going to pop over here. And what I can do is I can just sell 2 of these puts, and I can purchase, I can use some of this money. So selling 2 puts generates a credit of around $450, and then I can use some of that to buy a long put. And what that will do is it will create a spike on my profit profile. So if you look over here at this part of the screen, you can see the break even is now even lower at $95. The upper break even is 123. And we have this profit spike to the downside. And that was one of the reasons why the suggestions were that we maybe call it a scorpion, because it kind of has this tail that sticks up on the downside. And a lot of option strategies are named after animals. So it's kind of fun. I would love to know if this trade has a name, because it is a very basic setup. We have 3 options in total. They all have the same expiration. We're selling 2 puts, we're buying 1 put, all 3 of them are out of the money, and then we're selling an out of the money call. So it's a very, very simple trade. It's virtually neutral. You can see the delta on this is negative 0.02, so it's very close to neutral. And the stock obviously trading right now at 110, so it could move either down or up and still be in the profit zone for quite a distance, about $14 on either side, before we start to be in the loss zone. Now, these trades don't get closed as easily, like as a strangle. A strangle is very easy to close it early, and we know the benefits of closing early because we've been doing this for long enough. I hope you guys have learned from me over the years, and that closing early definitely does benefit us. And it's because the gamma risk gets taken out of the trade. So we get to kind of recalibrate every couple of weeks. When we put on a trade like this little scorpion trade, there is a little bit more incentive to hold it closer to expiration, because if we look at the dates of what this value is going to be later, closer to expiration, if I just scroll down here on November 5th, you'll see that the curve hasn't even come close to conforming to this spike. And in fact, it won't happen until the very, very end. So even if we look at November 9th, starting to see a little tiny bit of a hump to this side. So if the stock was trading around 102, that would be pretty good on November 9th. Then November 10th, we're looking at the still not very much relative. You know, the stock is moving an incredibly large amount from a $250 profit to a $500 profit overnight between November 10th and November 11th. So these make me a little bit more comfortable, and it's one of the trades that I have been putting on, or this type of setup has been the type of trade that I've been putting on for day trading, SPX, as of late, which my patrons are aware of. So we're having an incredibly good run, actually, even though the market's been kind of churning down. The results from day trading or zero DTE trading on SPX has been incredible these last couple of weeks. And this was thanks to my backtesting software that I generated, which is available on my website. So if you guys are not using that yet, and obviously my patrons, they have the download from September, so it is no longer available on Patreon. It's only available on my website. But if you're not using that, it has been great at being able to target the very high likelihood of where the market move is going to be. So it's been pretty fun, and it's been, quite lucrative. So that's kind of nice. So Chris, I hope that answers your question. The typical bear setup. So this is the type of thing that I'm looking at. So I'm trying to stay neutral because I want to make money if the market goes flat, which is the expectation. Market could go up, 3M could go up. And if it does continue down, I'm running into a bigger profit hump. And in general, this is kind of the ideal setup for my whole portfolio, and when the market moves down, I want to have a profit hump to the downside. So having this slightly short delta position is ideal from an overall portfolio perspective if we're looking at risk analysis over the whole thing. Okay, so please ask more questions because there's very little going on, and I see I have like 20 people online, which is amazing. You guys are fantastic. And I am going to look at Visa. Let's pull that up and take a look to talk to Andrew about what is going on. So stock's trading at 180.80, and if we look at, there's been some news for Canadians. I mean, we're in a situation where retailers are going to be able to start passing credit card charges on to customers. And it's been kind of in the news the last couple of days, and it's an interesting thing. I don't really know what to expect. I mean, how people are going to deal with this, if restaurants are going to suddenly, if we're going to see like a charge for our credit cards at the table, basically on our bill, or if they're going to refrain from doing that. So it's an interesting thing that's happening because they have the ability to pass it on in every province except for Quebec. And I don't know if that's going to affect Visa itself or MasterCard, or if the retailers are not going to add this charge on. And for myself, I mean, I have to consider if I'm going to be paying like a 2.4% surcharge on top of what I previously didn't pay. This is something that I might consider trimming back my credit card spending. Now, I really like to use my credit card because I get all the points and I get to travel on my points and do all that stuff. And I mean, I have been a longtime credit card user and I quite enjoy using it. I don't pay any interest, and Visa doesn't make any money off me, or MasterCard or any of the other companies, because I pay my bill off every month and I spend within my income level to be able to say, okay, well, this is my budget, or so to speak, how much I'm going to spend per month. But I do like to use it. And is this going to affect me? It may, because there is going to be charges that are going to be passed on to us, at least by some businesses. So globally, I don't think that this little change in Canada really affects these big companies. Visa still has half of its income from the United States from an international point of view, and that hasn't changed. So I was actually trying to find the statistics on how much revenue was generated from Canada specifically, or from specific nations, and they don't really designate it that way. It's like United States income and then international. So I thought that was pretty interesting information, but it does pertain to these companies and how much money they're making. Now, it doesn't really affect their income specifically unless people stop using their credit cards. So it really depends on businesses and whether or not they're going to continue to use or continue to charge, or to kind of eat that cost of doing business, which is what they did before. So just having the ability to do it doesn't mean that they're necessarily going to do it. Okay, enough about that. That's like long-winded about specifics in Canada. But what we're looking at here is we saw a very, very strong downtrend here in Visa. So since August, and this is partially due to interest rates rising. I mean, we know that spending is going to decrease, and the stock prices reflect that. The stock prices drop because the expectation is that people may spend less money because there's going to be higher cost of borrowing. So just in general, kind of globally, everybody's tightening their purse strings. And because of that, companies like Visa may not be able to make as much money. Now, the crazy thing is these companies make tons of money, like tons. I don't have it ready for you. I was actually thinking about prepping a little video on Visa, specifically on their revenue and their year-over-year growth. But if you look at a chart, you would be shocked at how much revenue they're able to generate. And they raise their rates periodically. So the fees that they do collect are massive. And I think that this downturn that we're seeing is going to be relatively short-lived. You know, everybody's talking about a Fed pivot, and when those interest rates stop going up, then it's going to change, you know, the direction of some of these companies. And so in the short duration, we may see some sideways movement. But what I'm looking for specifically, and what Andrew was looking at, was at what price will I start selling covered calls? So for me personally, I'm looking at this level that's right around 190. You know, I've traded Visa for quite a while, so and I've watched this level move around, and seeing this large candle here where we broke down below the 190, and the fact that we haven't been able to break above it, this is kind of my line in the sand for when I'll sell covered calls. When we're down at the bottom of this Bollinger Band on a highly profitable company, my expectation is up. When I have an expectation of growth or increase in stock price, is not a time where I like to sell covered calls. I will once we see this break above the moving average, and around this is at current point, it's going to be 190. Now, if the stock continues to fall further, then the line may become a little bit lower. But for now, I'm happy to hold, not selling covered calls on Visa. So hopefully that's an answer that's appropriate. Aspen Pilot says, thanks. You're very welcome. Thank you for asking. George Johnson, welcome. Well, thank you, George, for becoming a supporter. That's fantastic. Appreciate that. And Kevin says, good afternoon from Lakeland. Always good to see you, Kevin. Appreciate you joining. Peter, probably. Kaczynski, what strategy would you use if you assume the stocks will not fall below a certain level? Well, the bulk of strategies the bulk of the strategies that I use as a short premium seller all revolve around a short put. So it's kind of the bread and butter trade for short premium sellers. There's a couple of things that I always look at, and one of them is the VIX. If we look at the actual chart of the VIX index, let me just pull it up here for you. You'll see that we're in a very highly elevated VIX level. And if we went back to the weekly, just show you, because I don't know how many new people are here, but if we look back at 2019, we were in a kind of a normal VIX range. This line was in that 17 to 18 level, and this was pretty typical. And prior to that, if we went back even further, which I don't know how easy that is to do here, 2017 was actually an abysmal year for trying to trade options. I don't know how many of you were there, but it was this period of time where the VIX was low was terrible. At this point in time, where we are now, you can see this VIX is highly elevated, and we're looking at the weekly. So let me just switch back to the daily so we can kind of look at this year. And what is happening is we're seeing a highly elevated VIX level, and because of that, this is a great opportunity for us to trade. Why is that not? Doesn't feel quite right, that chart. February, January, because I'm scrolled way over. Give me 1 second here. Let me just reset this whole thing here. Let me go 1 year, daily candles. Let's look at that. Yeah, that looks better. 33 level. We were looking back at February when it was even higher. But as you can see, that's uptrend. You know, even a couple of weeks ago, back in August, we saw the VIX levels at 20. This is still high. 20 is high. 25 is high. So when we're at 33, it's extremely high. In high IV environments, selling puts is extremely lucrative because there's tons and tons of value in them. So it doesn't matter what the stock is. If we pull up whatever stock you want, nobody's said anything about any specific stocks. So I will just say, Goodyear Tire. You know, I put on a trade the other day in Goodyear. I am bullish long-term in Goodyear. They're profitable. I think they're going to continue to make money. And if I look at the chart, I might decide that looking at the 1-year chart, that they may not ever trade below $10. You know, they were up. This was a $24 stock not that long ago. And fun, isn't it? This is why I use TradingView. IBKR, I love their platform so much, but their charting is less than ideal. But Goodyear, let's pull this up and I'll just kind of scroll this up the screen here so we can see a little bit more compressed for you. There we go. So we were trading down here at 1010, 988. And say my assumption was that it wasn't going to trade below $10. If that was what I thought was going to happen, it's going to go up and it's not going to go down. How can I make money off that? Well, it's pretty simple. All I have to do is go out in time here and sell a short put. This is kind of the simplest strategy that you can ever use. And the thing about this that I like to do is calculate the percentage return on this. And when I do that, I typically build it off of the cash secured value. So I look at this and I say, okay, this selling a put, one contract, which is what I'm doing, selling one November 11th, 10 put. So 10 is the strike. I'm committing to buy shares for $10. And there's 100 shares in one lot. So this is a $1,000 position. And for this, I'm going to get $35, it looks like. Now, there's not a lot of option volume on this, so it may not get a very good fill at all. And I may have to go out to the monthly, which would probably be smarter. So let's just do that right now. 4,000 contracts trading as opposed to 2. So this is a much more lucrative, especially when we're trading these tiny stocks. So if I had $1,000 that I was willing to bet, then I was going to say, I am willing to buy stock in Goodyear, I could receive some money for taking this action, which is selling the put and entering an agreement to buy shares, 100 shares for $10 each. And I would actually get paid $80. So there's very simple strategy in this because, okay, now I'm really messing with you because I've got 2 legs on there. This makes more sense. $45. $45. You can see that. There's the bid. Here's the ask. $45 credit is what I would be collecting today. So I get $45 in cash. I have agreed to buy 100 shares of stock for $10 each. This is very, very simple math, and part of the reason why I chose Goodyear, because I can look at that and say, well, this is a 4.5% return. As long as Goodyear stays above $10, which it's currently at $11.26, then I get to take home or keep a return of 4.5% in a 38-day period. So this is extremely lucrative trading. Now, I could also be less greedy and I could just go down to the 9. This is still a very good return. Now I only have $900 committed because I'm only committing to buy the shares for $9, not 10. And my return would be about $25. So $25 divided by 900 works out to 2.7%. And this is why a short premium in high IV works so well, because it's just extremely lucrative, making 2.7% for the stock staying above $9. Simple trading and relatively low risk, because the worst case scenario, I get to keep the $25 that I collected and I have only paid $9 for the share in a very strong company. All right, let's move on. So that is, Peter, that's the answer to that is short puts. Aaron Phillips, the problem with the stock market is investors don't care if a company is profitable. It has to be consistently generating more profits, growth above all. Absolutely. I think one of the things that I'm looking at with any country right now, because profits are super important in a rising interest rates, the growth here is a C on Visa, but their momentum is picking up. So this is why it's getting a hold rating on Seeking Alpha. So if we look at Visa, in particular. If we look at any stock that doesn't have a profit, they almost all have like a sell rating on them because the interest rates could go up. Even looking at Meta, I mean, Meta is down, trading at 130 right now. It's got a quant rating of a hold, highly profitable. But again, exactly what Aaron was saying, the growth is not great. You know, the expectation is that they're not going to be growing over time. If we look at companies like Netflix, we'll see the same sort of thing. Profitable, their growth is only a C+, so they get this hold rating, and this is part of why the AI software pulls up the hold rating on these companies. If we look at even companies like Apple right now, highly profitable, tons of cash, but their growth is poor. So because they have poor growth, they have a quantitative rating of hold. When we look at bigger companies, or no, I shouldn't say bigger companies, they don't get much bigger than Apple. If we look at companies that have potentially more growth, PBR comes to mind. And then, yeah, wrong about that. I thought their growth was better. Quantitative rating again on hold, but profitable, decent momentum. Who else is in here? Just trying to think here. Who is going to have decent growth? No, that's the uranium ETF. Now I'm just like grasping here, trying to find something that's going to work. But who's growing? Like Hulu. What's the ticker for Hulu? Don't know who that guy is. Okay, let's click off that. And let's go back to IBKR and look at a couple other questions. So Andrew says, thank you. You're very welcome. Appreciate that very much. Pink Lavender, if you liked Visa and potentially wanted to own, would you sell a put? What strike would you choose? Well, when I like a stock and I want to buy, then I sometimes choose strikes that are actually in the money. Is something that I like to do because it's the same as buying a covered call or buying stock and selling a covered call. So on Visa, if I was to pick a short put, we'll look first at we'll go back to the chart. I'll show you kind of my assumption. Let me collapse this just a little bit here so we can see this above me here. I could agree to buy the shares only if they go below 170. I could pick 165. But I could also go in the money. I could agree to buy the shares for $200 right now. And what that would do is it would actually give me upside potential. So if I thought that Visa was going to go up before the next earnings report to $200, or if I was okay with committing to buy it for $200 a share, I could get paid quite well today. So let me show you how that works. So if we go to Visa, we'll go a month out again. Since we're getting so close, I'm just going to go to the monthly, which is November 18th. On IBKR, you can see the monthlies are highlighted in white. So you can see that this is white here, and then November 18th, and then we see the December and the January, and the weeklies haven't yet appeared because the weeklies don't get written until about 45 days out on most of the stocks. So if we look at, you can see November 25th has 45 days to expiration, and then in 7 days time, there will be one for December 2nd that will pop up. So November 18th, we'll take a look at that, and I could sell the 170, and for that contract, I would be getting paid $465 today. So I get $465 in cash. My agreement is I will buy shares only if they trade below 170. Likewise, I could sell the 175. I would get paid $620 for this, and I would only buy shares if they were trading under 175. But I could also just sell the 185. I would get paid $1,045 today. And I would agree to buy the shares if they were 185, which means that if the stock goes up above 145, I have made $1,000 doing this because I would get to keep all of this money. I wouldn't be obligated to buy the shares. And so selling this in the money put can actually be quite lucrative. I could agree to buy the shares for $200 and I would get paid $2,000 today. So I would get paid $2,050 in cash. And if the stock went down, or stayed the same, I would be on the hook to buy it for $200, but I would have also collected $20 per share, just over $20 per share. So still getting some extra value. That extra value is really easy to see if you just look at the opposing side. So if you're looking at the 200 short put, The extrinsic value or extra value that isn't in the money, in this case, is an extra $200. The 195 has $300, the 190 has $500, and the 185 has $700. Extrinsic value works on a bell curve. There's the closer to at the money, which is where the stock price is trading right now. 180 is the at the money. So this, wrong button right there, but right in the middle of our screen, the 180, that is the at the money contract. And it has the largest extrinsic value. So on the put side, the 180 put is slightly out of the money, has $800 in extrinsic value. The 185 is out of the money and has almost $700 in value. It is very, very lucrative to trade these at the money options, and it's a very simple trade. Instead of buying stock, I just sell the 180 put. I get $820 deposited to my account today. You can see what that would look like. If I said submit order, it would just say amount, $820. Let me change this arrow. I feel like you guys can't see that. The amount of $820 minus the commission. After commissions, I would get paid $818. And then I would be on the hook to buy the stock for $180. If the stock stayed above that 180 mark, I just get to keep that money. That's $800 in my pocket this month on this trade without ever buying the shares. If it drops below, I still get to keep the $800. So I have a cost basis of around 172. Even if I was assigned the shares. Cost basis doesn't quite work like that. Cash, the option premium is separate and doesn't reflect in our cost basis, but it is something to be aware of if we've collected $800 prior to buying the shares for 180. So I like to kind of keep it in mind, but it's not the be all end all. Agris, good evening from the EU, Baltic States, Latvia. Well, good evening. Awesome stream. Just want to be crystal clear. Is there assignment risk using also credit spread strategies? Yes, there's assignment risk on any short option at all. So if we did, let me just do it here on the screen. When you ask about assignment risk, let's say I sold an iron Condor. So I'm selling the 160, I'm buying the 155. I'm selling the 200, I'm buying the 205. This is an iron Condor. For beginners, I think this is the trade that everybody should learn. It's like the dead simple trade. Theoretically, you have limited loss. And when I say theoretically, it's because there is assignment risk. And this is why I show this particular trade as a setup. If the stock was to trade below 160, there would be assignment risk of this short put. Because it's short and I'm selling it, I actually have a negative quantity in my account, then I don't have I don't have control over it. When I'm purchasing the 155, I'm the one with control because I own it. Likewise, on the short side, on the call side, I would be short the 200, which means I don't have any, I have negative value quantity wise, and the 205, I have a positive quantity. So in the short options have assignment risk. The exchange has control as to whether or not they can assign me shares. As soon as I have entered that trade, it can be assigned at any time. Now, obviously, the exchange is not going to force me to buy shares for $160 when the stock is trading at 181. That there is no assignment risk on this particular 160 position. Likewise, there's no assignment risk currently on the 200 call because, again, the exchange would not call my shares away or buy the shares from me and pay me $200 when the stock is trading at 181. It doesn't make any logical sense. So when we're in this position, if the stock moves against us, that's where there could be a problem. So let me just look at the put side, and let's just say we had a different position on. We had a Condor that was much higher. We had entered it when Visa was trading at $230, and now the Visa's trading at 181. I am still short the 200, and I am long the 195. Now again, no assignment risk on the 195 because I own it. I'm purchasing it. You can see here, buy one. The quantity in my account goes from 0 to 1 when I enter this trade. When I sell one, then the quantity of this 200 would go from 0 to -1 because I'm selling one and I started with 0. Once this is in the money, there is assignment risk. The assignment risk really only takes hold when the extrinsic value goes to 0. This is why extrinsic value is super high. Or not super high. We want extrinsic value to be high. Extrinsic value is super important to understand. In this case, the 200 short put, if I held this in my account, any exchange that was assigning me these shares and forcing me to buy them for $200 would be leaving money on the table because they would be giving up the extrinsic value. If I was assigned on this 200 put today, myself as a trader would actually benefit over the exchange. There is currently no assignment risk in my mind on this position because there's extrinsic value. Now, if we looked at a closer date, let's look at the exact same strategy on a closer date. You will see that here's the 200. Here's the 195. Now, in this case, there's tons of assignment risk because there's no extrinsic value. There is such a small likelihood that Visa is going to be trading above 200 over the rest of this week that there is only 2 to 3 cents of time value. When this extrinsic value has dropped to 0, basically the total value of the contract is just the difference between the current price and the current price and the strike. So in this case, 1860, and the stock is trading at 181.63. So if you took 200, you subtracted 1, it would work out to 1. You can almost calculate exactly what this would fill for because there's 3 cents difference. So it'd be 200 minus 3 minus 180.25, and you would know exactly what the fill price would be on this. It would be the remainder. It'd be around 1870-ish. And if you look at the value in November, there's going to be much larger quantity or much more premium because there's extra $200 in time value. So if I had a spread that was expiring October 14th, the 200, 195, I have assignment risk on the 200. And this could turn into a big loser if I wasn't paying attention, because if those shares were assigned and I didn't immediately go in and execute my long option to protect it, then there could be a price discrepancy. And this is why I don't like to hold spreads through expiration if the valuation is close. So if it's very, very safe and it's not likely to move after hours, I have no problem holding spreads to expiration, but typically I don't like to. So it really depends on how much extrinsic value. I hope that makes sense. And it's opposite on the calls. So if we looked at, the 180 call, even expiring only in 3 days, if that was the only position, if this was a spread, if we had like a 180, 185, and I was worried, is this going to get assigned? Well, it's not going to. Even though it's in the money, it's got $200 in extrinsic value right now. So it's very, very unlikely. Now, in 3 days' time, this extrinsic value is going to go to 0. And on Friday, this will definitely get assigned. But right now, it's not going to. So it depends on how much extrinsic value there is. Hopefully, that was an all right explanation for you guys. David says, RLMD 1021 expiration, 30 puts, pays crazy premium. Is it worth the risk? Investing or gambling? RLMD. I don't know what that is, David. What is RLMD? Usually if there's crazy premium, there's usually crazy risk. RLMD. Let's look. There's probably, I was going to say this is a pharmaceutical company, but it's therapeutics. This is the same. So what's going on? Do they have an announcement coming out? $5. Yeah, that is some crazy premium. Okay. You know what? I like these types of things. So 14 delta, 70, this is 10 days away, 70 cents. Yeah, these are some crazy premiums, 9,000 contracts. What does RLMD do? Obviously, they got some news coming out. Where are we going to look this up? Let's look up RLMD. Relmada Therapeutics. Strong buy. They're not profitable. That doesn't surprise me, but So they've got key phase 3 short-term catalyst lined up. Let's see what it is. I love to do this kind of stuff live, so it's kind of fun to just find out. I have no idea what they're doing here, but expected in quarter 4, and they're biotech, and they're developing therapies for depressive disorders. They have 200 million in cash. Just doesn't sound like a lot, really, when you think about it. 200 million, you can blow through that here pretty quickly. Okay, so I'd have to obviously read this and find out what the release date is, but there's a catalyst coming up, and so that is what's going on. Now, these are the types of trades where if you get creative, you can build some amazing things that have extremely low break-evens. So the first thing that I would look at is just saying, okay, well, what if the stock's at $30? Can I still make a decent return even if it drops to $10? And you can. Like, this is actually a really great return, making $70 on a $10 stock. But you never know with these. The stock could go to zero. You know, it doesn't necessarily mean that it's going to stay above $10. But in this case, a 96% probability right now that it would make around an 8% return on capital over the next 10 days. Obviously, the announcement must be coming here pretty quickly. So that is one way to do it. When the premiums are jacked up this much, then what we can do is do that little ratio spread on here. So we can do a 2. And then we buy one of the 1250s. And this doesn't generate as much money out of the gate, but still a very, very good return. Spreads seem wide in there. I would hope I'd get a better fill price than this. But so that would be a 1.5% return on $1,000. But what you'll see on this is that the max loss will be actually lower. The max loss is now $780, whereas before it would have been $930. Because I would have been getting 70 cents on a $1,000 profit. And so even on a 100% move, the most I could lose is $780. And there's now a greater potential that if the stock did drop, it could actually go up. This profit spike could go up higher. This is where I typically start to pull out my own calculator and just take a look at some of these, because I do have a comparison calculator that I can run that's a little bit more specific to these positions. So in this case, where's my break even? Max loss is 980, so same as the naked put by itself. And if I could get an 88-cent credit, that's even better than selling this naked put. So this trade has the same break even, slightly lower break even actually, and profit potential of up to $250 if the stock was to drop right to $12.50. And this is, you can just get as creative as you want with this. You can build all sorts of things. This is basically a zero cost to enter. So you're getting almost nothing in a credit, but could make up to $500. And then depending on sizing, then you can also play a little bit more. You can just say, well, what if I bought one of those and then I sold 4 of these? What does my profit profile look like? So now I'm getting that 90 cents. I've doubled the amount of contracts. Obviously, I've gone from 100 to 200. So I've got 2 put spreads in here and then 2 naked puts. So I have agreed to buy stock, but I could make up to $750, which would be my max. The max return would be $570. So if I could get filled for a 70-cent credit. So this is these are ways that we can play with these options that have high valuation. And then your hope is that you actually are looking for it to go down. If it doesn't go down, you've still made a 9% return or thereabouts. And if it does go down, you have a chance of making like $500. And the real risk here, obviously, is if it goes below $12.50. And these are, this one's showing a probability of profit of only 12%, but that is incorrect because I wouldn't open this trade for a debit. And this chart is showing that this is open for a net debit of 20 cents. If you look down here, it's calculating off this low number. if it was open for a credit, then this entire line here would be a profitable line. And that's where I like to use my software, which I can pull up here if you like. Just give me one moment. I'll pull that up and I'll show you kind of how it builds out, because it's pretty slick. Where is that? Just bear with me for one moment and I will pull up that information. Kind of fun to do these on the fly, isn't it? So that RLMD is definitely a fun little thing. If the market doesn't sell off, I mean, there's huge premium in it. I wouldn't be selling the 30, that's for sure, because the stock would drop to half and I would still want to get I'd be buying it for 25 bucks. And if it goes, it's just $2,500 to $100 wasted, in my opinion. But that's, for everybody to decide, so what they want to do. So I'm just going to pull this up here. Bear with me for one more moment, just about there. And what I'm going to do is flip over to this. So what you're looking at is actually a tab in my rolling options record keeper, which I use all the time. And I have the ability to just build out different strategies. So first thing I'm going to do is go RLMD, so we know what we're talking about, and the current share price. I have it so that right now in my sheet that this is manually entered, but the current share price is $31.98, right? Is that what it was? Where are we here? $31.88. So just going to plug in a little bit of different information here. I'll look at something else while I plug it in, so you don't have to watch me flip back and forth so much. So this current price is $31.89, and I don't own any shares, and basically I'm just going to zero this out. So I'm going to just delete this and we'll start fresh and say, well, what is this going to look like? So just delete this all. And I can do like a short put. So I can just type in put, and we'll do cash secured put in this case. And we did the 10 strike. And for that right now is going to get 80 cents. So the option expiration date is 10/21. And then the credit for this is going to be 80 cents and one contract. And the margin requirement, we'll do it cash secured. So in this case, it would be 910. And that would be your max loss. And then we'll go to... We're going to have to go pretty wide here to see this all, because zero. Let's go to 1. There we go. Now we can see it. And then the next thing we're going to do is we'll just do a custom here, and we'll say we're going to sell a 10 put and we're going to buy a long put. And same date, October 21st. And then for this, what we would get if we sold the 112, let's drag this back on for you here. Can I do that? No, I can't do it very easily. So the net credit of selling 2 of the 10 puts is going, yeah, I do want to show you this. Show you what I'm looking at here. Okay, so we're looking at, so we know what everybody, so everybody can follow along. We're buying 1 of the October 21st 12.5 puts, and then we're selling 2 of the October 21st 10 puts. And it tells us that the net credit is going to be around 15 cents. So we'll assume that's correct, and we'll plug that in 15 cents. And what I've done here is I'm selling 2 of the short puts. So I put in 2 of them in 2 different lines, and then the transaction credit, we're going to go 15 cents. Now this is a put ratio spread. So I can actually use that from my pull down, and it will, so I can go put ratio spread, and it will highlight the cells that need to be entered. So I know which ones I have to enter. And then when it all gets entered correctly, I will get, it will show that this is not pink. Right now, the pink is showing me that something is incorrect in this formula. And what it is this blank cell, this white down here. I'm just going to scroll down over to the chart and see what the total loss is going to be. And if it was at 0 here, it's going to be whatever, 760 bucks, right? Why am I having such a hard time? Every time I demo something live, it's like, which is problematic. But the big thing here, the big key with comparisons is looking at like what type of profit comparatively. So if comparison one, this cash secured put, sure, I make $80 if the stock stays where it is. And in this red line, I only make $15, but I have a lower break even. So if it goes to zero, if the company completely goes bankrupt, then I lose less money with the put ratio spread. And this is where I was saying I could build out something even stronger than this or more complex if I wanted. So I could do another one. I could say, well, what if I bought the 15 and I did a 10 and a 10, and how much money do I get for that? So with a little bit of playing around, if I could type, then we get to see the entry. This one's going to be a negative entry, but it's going to give me a higher break even, or a lower break even, which is what we want. So I would be selling 2, buying 1 of the 15. And this one would cost me money. It would actually pay a $40 debit to enter this. And in that case, this comparison is going to be one that I'm not likely to take because I don't like to enter put ratio spreads for a debit, but way lower break even. So $453 if the 453, so it works out to $500 if it goes to zero, just above 400, 500, 463, something like that. Anyways, you guys get the idea. So I can now compare and say, well, where, if the stock goes up, obviously the trade that I want to be in is this blue one because it makes more profit. And it's a different way of being able to look at these options. And it's something that our brokerages don't allow us to do, which is why I built this software. And this is part of my rolling options record keeper. So if you don't have that, if you're a patron of mine, obviously it's a free download as soon as you become an options tier member. So this is something to consider. Rolling options record keeper. It's the one I use on my daily basis. And it's the one everybody sees all my posts in the chat room, which everybody loves this. The chat room's great. The spreadsheet's great. Everything's fun, isn't it? Let's look at other things here. Having a hard time with my chair today. That's odd. Peter says, thank you. You're welcome. And Vladin says, hi, Levi, OSK, Osinko Mining. Any thoughts on a buy right? What do you think about Canadian mining? I have lost a lot of money in Canadian mining. That's what I think. Mining companies are tough. Let's look at Seeking Alpha. Actually, I pulled up. Let's just look at must be on the TSX. Let me type the ticker. Here we go. TSX. Typically I don't play these kind of things. Mining companies chew up a lot of money. Seeking Alpha is unlikely to have a review on this or a rating on this. Looking back at the 5-year chart, relatively flat. Do they pay a dividend? No dividend. 1-year target estimate 570. I don't know how many people cover this. These are such tough goes. Like how do you get any information on these companies? I feel like even people that are insiders don't necessarily know what's going on. So pull it up here. Let's look at the option chain and just see what there is available. There's no dividend, so doing the buy right doesn't make a huge amount of sense to me. I think I would probably just sell it in the money put if I was doing it. I would just say, well, the stock's trading at 223. What if I just sold the 325, collected 25 cents? Could I get that much? 20 cents ish. So if I did this, I'm agreeing to pay 325. I'm collecting 20 cents, which means my break even on this trade is $3.05. And the profit profile is such that if the stock goes to zero, I lose a total of $305 because that's how much it would cost me to buy the shares out or buy out this contract. I would have to pay $325 minus the $20 that I collected. Extremely good return, actually. But obviously there's a little bit of risk to it too. Trading the short put that is that is out of the money, getting 10 cents on a $3. This gives me a break even of 290. So obviously a little less risk, but max profit of $10. I don't know. There's a few things I don't love about this. The first thing that comes to mind is there's no volume here. Second thing, I don't know the stock at all. But before I did a buy right, I would just be doing selling it in the money short put, because if the stock rallied up, I would get to keep my $40. Break even on this is $3.10. Hopefully I'd be able to roll this out. That would be actually one thing that I would look at. How much money does it generate to roll? So if I was buying back the October 21st 3.5 put, which is in the money, and selling the November, getting about 10 cents, just 3 times. So it's about 3%. I mean, it's pretty lucrative, but I just don't know anything about the company. So mining can go to zero pretty quickly. They can just spend their money. Obviously, this is not the trade that I'm looking at. I'm assessing whether or not it would be worthwhile to roll a short put that had gone in the money, and that's kind of how I would assess that. I don't think it's going way up. So if I did, obviously I could just sell further out. I could just sell further in the money, and there's a couple contracts here, but low volume, wide spreads. Actually, not even crazy wide spreads, but yeah, good luck with that. I'm not going to take it, but I've lost enough mining in my life to not take those trades anymore. Do you always use limit orders to selling options? Yes, I do. Why would I use a market order? If I put in a market order, then suddenly I'm in a position where it could get filled for a price that I don't like. So I don't buy stocks with a market order. I don't sell options with a market order. It just is nonsensical to me. My brokerage makes it really easy to put a limit order in, and I always do limits. And I know how much I'm going to get or not get. Zildin, anything looking interesting for fun earnings play this week? Pepsi, WBA. I haven't looked at earnings at all. Let's look at the expected move on Pepsi. And I don't know when the earnings come out, but obviously you're saying it's this week. So expected move, to calculate expected move, we're just looking at current price, gives us the at the money option, which is 162.50, and we just add the two values together. We times that by about 0.8. So in this case, it's $5. So 5 times 0.8 gives us a $4 expected move. So we can expect that Visa, well, I got Visa on the mind. We can expect that after earnings, Pepsi is going to trade somewhere between 158.30 and 166.30 would be its typical range over earnings. So let's just take a look at that and see if that is a reasonable range. I don't know what Pepsi's been doing. It's not one that I play very often. It's pretty. I saw in one of my trading groups somebody was assigned some KO stocks at 55 the other day. KO is Coke, and I used to play Coke quite a bit, but the earnings, the premiums are not fantastic, and I just kind of shied away from it, and then you get out of the rhythm of trading it. But here's the 158 level on Pepsi, and then the 166 is way down here at the moving average. So that's the expected move. I think that in this kind of situation, I don't love trading earnings when I've seen this kind of channel happening. So if you're, there's the expected move. If I'm looking at this and I kind of start drawing some lines on here, there's the channel it's been trading in. Typically when I trade options, I'm looking for some sort of neutral trade. And this is tough. Like they're either going to have great earnings and then the stock's going to rip right out of here, or they're going to have okay earnings, in which case what's going to happen? Like, we're going to see some, I don't know. your guess is as good as mine when we see like a downtrending channel like this, even when it is close to the Bollinger Band. But this is a pretty steep moving average right now. And if the earnings are bad, then and is it going to completely blow out? I mean, probably not. It's Pepsi, but we kind of have to scroll back and see where if there's any resistance or levels or what the expectation is. And the further back you go, and we were looking earlier at 3M, and it was at levels going back to 2020, right? And then Pepsi's trading well above that. I mean, even in the pandemic here, this is March of last year, on an outlier move, could the stock drop like that? It could. Who knows? Like, they could come out and say, yeah, we're having a really hard time with inflation. Now, I don't think Pepsi's going to do that. My expectation is that they would probably trade flatter than huge down move, but we don't know. If we knew, it would be easy, right? It would be easy. So I'm probably not going to play Pepsi earnings. I'm going to probably sit out most of the earnings, in fact, in this upcoming session, because it's just too hard to tell what is going on. And we know from doing it long enough that over time, you just end up losing big sometimes, and it takes out tons and tons of earnings wins over the years. So they can be fun to play. When I do them, I trade them very, very small. And it's likely that I will be sitting out. So Walgreens earnings coming up Friday, it looks like. So that'll be Friday before Thursday. Got to scroll in here. Thursday. So I don't know if that's before or after. Doesn't say, but similar sort of thing. We're not seeing a range, so I don't personally love to trade these when there's a binary event like this. Why do it? It's already downtrending huge. Could just drop further or could jump way up. Both situations are highly probable, and the reality of trading earnings is that typically we make money when the stock doesn't move very much. We're trading a tight range and hoping that it stays within it, not looking for big moves. Pink says, Bruce's music journey. Thanks for joining, Bruce. Such great info here. Thanks for sharing your knowledge. Appreciate that. I love to chat about this. It's kind of fun. Aaron Phillips, SPY was looking good today, not so much for that. What is going on? Are we seeing a little bit of it's still in the range. I just want to see here what SPX is. Yeah, that might be. See, this is where it's 12:07 right now. We've got just about an hour before the market close. I have a little broken wing butterfly, and broken wing butterflies make money when there's pressure to one side of them. So I actually want the SPY to drop a little bit further. 35.55 is my take profit target, and we're not even anywhere close to that. So that's good that it's come back down a little bit, and I am not complaining at all. This is why it's fun to do day trades once in a while. In fact, I've been making more on these day trades, and that I wish it would offset some of the bigger moves in my account. Hasn't quite been the case. But the 0 DTE trades, because we are in such a short window, it actually is relatively easy to make a decent amount of money on them. So Foyad's asking, hi, late to the party after yoga. Love it. What kind of yoga do you do? Let me know. Kareen does Iyengar, and I do whatever beginner yoga. I'm not like a super yogi. I just know I hate flow. That's like torture. Last week, I asked how to handle the call spreads when challenged. I think the question of the day, do you always roll puts or prefer assignment and then sell calls? I almost always roll puts unless there's a dividend involved, because the dividend is like, why hold the stock? It's more capital efficient to hold the short put than it is to tie up the cash and hold the long stock position. So there's occasional times where there's a benefit if a stock is trading down like they are right now. When I'm selling my puts, I'm actually typically when I'm rolling my puts, I'm actually typically buying stock at those prices. So if I could get 1% a week for my roll, and say I'm doing it on only 100 shares, I'm buying that additional share every week rather than keeping it in cash. And the reason for this is because I believe that the market will recover eventually once we see this Fed pivot, once things get going. I'm only selling short puts on strong companies right now. And when the market is going down, what I want to do is I want to buy shares. So by kind of sprinkling that cash into the market, I am getting a couple of shares here and there. And one of the benefits of holding shares, and it's a very, very small benefit really, but it does allow us to defer tax. So if I feel very strongly that a stock is going to go up substantially, and it doesn't pay a dividend, then that would be a time where I would prefer assignment. So I would say, okay, well, I'm going to take these shares because my assumption is that I'm going to hold them for a very long time, and then I can have a different tax bracket, or I can peel out those shares or sell them off at some point in the future and decide when to pay the tax on them. When I roll a put, I have to pay the tax that year. So because an option contract is continually expiring, then the taxation happens on a year-to-year basis. So that is one of the few reasons why I would prefer to own shares, is when I'm trying to avoid taxes. In general, I would say 99% of the time I am just rolling short puts unless they pay a dividend, in which case I'm usually selling an in-the-money put anyways, and I'm trying to take assignment so that I can collect the dividend. So it depends. Right now I am in accumulation mode, and I am buying up tons and tons of stocks just in little amounts, getting some decent dollar cost averaging, and in hopes that the market's going to rally up, I'll get my shares called away from me, but I'll end up with some residual shares, which can make some money over the long term. That way, if the market stays flat, I'm just buying a couple of shares here and there, and I'm utilizing as much capital as I can. Boy, saying, Ashtanga yoga, if I spelled correctly, more to maintain shape, not real yogi myself. Yeah, strength, right? It's like you get into those like shaky yoga poses. It's always fun. That's me just shaking, just trying to hold myself up. Terrible. I'm much better on the slope and just going up the mountain. That's where I like to be, not facing the mat, thinking I'm gonna crush my teeth. George is asking, I have a question about GLD and TLT ETFs. Do you think they are liquid enough to trade weeklies? Yes, I do. GLD and TLT, yes, both of them are. If we look at, let me just pull those up. Are they on my watch list? They're both in my watch list in my real brokerage here, but let me just add them here because this list just grows. People always ask me about watch lists. They're like, well, how do you get a watch list? I'm like, well, this is exactly how I go on, and I talk to people and I trade things for a long time, and things go on and off your watch list over time. But if you look at GLD, these are 3 days. So these are the weeklies. There's tons and tons of open interest on all the strikes. So there's more than enough here. If we look at the spreads, but when I say spread, it's the difference between the bid and the ask. So in GLD, 3 days out, the 152 strike has a 2-cent spread. There's a penny spread on 152 strike. The 153 has a 2-cent spread. These are as liquid as it gets. So there's no cost to jump around. When we get way out here, the 160, we're 10-cent spread, still within tolerances. So GLD, no problem trading the weeklies. TLT is going to be the exact same thing. When we look, I'll pull up an example of something that doesn't have good spreads, and then you can see the difference. So the 3-day contracts, seeing a 4-cent spread, 5-cent spread, 5 cents. And this is not that great considering the volume almost 3,000 contracts traded today. But lots of liquidity in all of these. Every week, lots of liquidity and relatively tight spreads, enough for us to be able to trade it. If we look at like GT, which I had up earlier, see the spreads are quite wide. So $1.45, $1.60 with just lower volume. This was on the monthly. So we were at 15 cents. But if you look at the weekly, we're 25 cents. So now all of a sudden the theoretical cost of like selling and then immediately buying back, I'm out $25 on a $130 product. So these spreads are a little bit too wide, and it's really because of open option interest. So I'm looking at this volume section here, and that will dictate as to whether or not these spreads are going to be tight enough to trade. But GLD, TLT, absolutely. Foyed's asking, I appreciate the answer. Thank you. If you didn't mention before, how are you handling the AMD if you have a position? Well, AMD has been just absolutely like clobbered. But one of the things that I like about AMD is, again, profitable. I'm going to keep bringing that up. I believe their long-term outlook is going to be good. I believe there will be stock recovery. And when I'm looking at positions, what I can do is I can roll down. I actually talked about this in my chat room this morning, but when I had a 90 put on, and in this case, we talked about extrinsic value earlier in this live stream. So the extrinsic value of the 90 put November 18th is only 10 cents. So we're looking at assignment risk in this case because there's only a cost of 10 cents per share that the brokerage would be giving up to force me to buy these shares. When stock has moved substantially, what I sometimes do is I actually roll down to lower strikes. Now this is costly. You know, I'm paying money out of pocket to get to a lower strike, and I am taking a different type of risk. I am basically putting myself in a position where I am buying $15 worth of commitment back. So I'm changing my commitment from a $90 per share commitment to $75. And it costs me almost the whole amount of that money. And the reason the risk is different, so in this case, it would cost me $14.67. So my benefit in this case is only $33. And it seems extremely weird that I would do that. Why would I put $1,500 or $1,465 to only gain $30? Well, my assumption could be that AMD is going to take a while to recover. Now, if that's the case, there is greater extrinsic value in the 75 as opposed to the 90, which means that over the next 38 days, this 75 put, which is in the money, is going to lose value, time value of $50. And the 90 put is only going to lose time value of $10. If I look at it from an annualized perspective, let's just say that I was in a position where I had to hold this and AMD stayed at $60 for the next year, if it just traded flat. If I hold this 75 put and I make 50 cents a month, then in time decay, at the end of the year, I'm going to have made $600 in time decay, 50 cents times 12 months. If I roll this 90 put, I will only be getting 10 cents a month. So I'll make about $60. Well, that's a substantial difference over a year. And we don't really know how long this bear market's going to take. And we don't know how, how slow the recovery is going to be. So when I'm in positions like this, that is kind of one of the defenses that I consider. I consider paying $1,440, which only looks like $50 a month. But at the end of the year, if AMD doesn't recover, I have made the right decision because I have paid now to then collect more time value over time. As the stock rolls up, I am confident that it will come up slowly enough that I will do the reverse. I would be in a position where I would be buying back the 75 and then selling the 80. And in this case, I wouldn't be getting quite as much money as the full $5. I would be losing out a little bit as well, but I would be getting back most of that money. And so I can kind of play with this. That's if I have a single contract position. So all of this is assuming that I've only traded, one lot of 90, and that's my entire position. Now, generally, I like to add to my position. So if I have a 90, and what I could do is I could continue to roll that 90, only getting 10 cents. And then what I can do is I can add another position. I can say, well, now that the stock is trading at $56, I have a position, I have agreed to pay $90 for these. Well, if I buy another 100 right now at $97 or $57, I have now 200 shares, but a much lower cost basis. So that's one thing that I could do, is I could sell a 55, like an at the money put, and I would collect an additional credit for that. And I would now have 2 positions that I'm rolling. When I go to roll, this 55 has way more extrinsic value in it. So when the market is down and has tested these short puts, that is a nice time to be able to dollar cost average, because that's what I'm doing by adding that second put, is purchasing another 100 shares and bringing my cost basis down to half between whatever the initial strike was and whatever the new strike is. And now I've got 2 positions that I'm rolling. Over time, this is going to help me, because the at the money is going to generate more money, and then I can use that to roll this down. I'll give you an example of that. Let's just say I was coming up to this position and I had the 55 that I needed to buy back, and I had a 90 that I needed to buy back, and these aren't even going to be on here. There's no value in the 90s, like they would have already been assigned, but let's just say they hadn't. So I'm in a position, I've got the 55 and I've got the 90, and I have to sell them. I have to buy them back so I don't get assigned. Well, I might just roll out to November, and when I roll to that 55 and 90, I'm going to be generating a credit. Well, I'm generating a credit here of almost $200. In this case, what I could do is I could actually use that $200 to lessen my commitment. In this case, I would pay, again, a debit, which I don't love to do, but I could do this in this case, pay a debit of $277, and it's actually decreasing my commitment by $500, because I'm using the roll from the 55 to finance the roll of the 90. And this is why scaling is so important. And it's hard for option traders. Like when you start out and you have a small account, it's hard to think about that. Like oftentimes you're like, well, these 100 shares are all that I've got. And then you're trying to defend 100. But as your account gets bigger, you're like, well, I'm going to buy 100 shares now. And then if the stock goes down, I can buy another 100 and another 100 and another 100. And you can kind of get that cost basis over time. And it's unfortunately, the people with bigger accounts have a little bit more flexibility, and it is more difficult when you have a smaller account. But that's one way to do it. 12:22. Yeah, we have time. Aspen Pilots, if you have time, CAT. I have long shares I sell calls against, usually weekly 20 delta, 15 delta, 2 calls for every 100 shares. Anything else I can do? My adjusted cost basis is well below current levels. Well, CAT, I love that you're selling 2 calls against it. I mean, that's really smart. If we just look at CAT in general, are the weekly premiums good enough? So we're looking at 20 delta, 15 delta. Okay, those are relatively the same, but yes, that is kind of how this is the approach. And then if we look at the add a stock leg to this, so this is what it would be like to buy the position today. It's a straddle basically, and it's very, very tight little strangle. And every day, I get asked this question all the time, like, you're adjusting positions, these are new, these are closed. Whenever I hold a position in my account, it is theoretically a new position. There's no difference. If I want it to be closed, I better close it right now. Otherwise, every second that I have it open is exactly the same as opening a new position right now. So right now, from the current levels, this is the break even, 176.206. Is that realistic and relevant to this trade? Is that in line with my assumption, 176 and 206? That's what I have to ask myself. So when I look at a chart of CAT, I haven't traded CAT in a while, but that's looking like a pretty good level to me. I mean, here's the 206 up here. Just drop one in here. Let's see. Let's actually use TradingView. 26. What did I say? 2608, something like that, right? Okay, so there's that line, and then the one. What did I say? 176. Got to go back to line here. Just give me a moment. 176. Somewhere in there. So if that's what I thought CAT was going to do, then that's the profitable area on that trade. That's where I'm going to make money. Now, if I thought that CAT was going to, there's no way it's going to trade above 190, then I might take a different trade. I mean, because this is the break even on that trade right now. And what I might do is I might sell a much tighter call. And I know this seems counterintuitive, but what I can do is I can sell 180, 187 this week. And now the break even is going to be 172, 195. And we'll look at what that looks like. So now if we look at, and it's off again, 170, 172 is now down here. 172 right here. And then 195 is here-ish. I should learn that. I should learn how to use TradingView. I was just using it for demos, and I just fumble along. But if that was this lower band here was the zone, so if I didn't think there was a chance that it was going to be at 208, why would I sell the 15 delta and 30 delta or 20 delta? If I didn't think it was going to go above 195, this would be smarter because I give myself a lower break even here. I'm giving myself greater risk to the upside to then give myself greater protection on the downside, if that makes sense. So that's the kind of logic behind it, and it's how I try to assess most of my positions. And you know, my patrons know, like I've got positions like on Etsy. I mean, I just roll my in the money covered calls. They pay me fantastically. You know, I've got the 97 on, so my break even is down here, you know, $97, and it's right in line with, and then I sell the 113. And am I really scared that Etsy's going to break out? Not really, because the reality is the stock is trading right here today. So I want a neutral position on. I don't want to have a position that's making me tons of money because I'm worried about Etsy breaking out. I've got equal risk to the top and bottom, and I can still make money at a pretty decent clip on those. Frederico's asking, hi Levi, what's your morning routine to get the trades flowing? Well, I have a watch list. Everything's off my rolling options calculator. So when I look at it, it's all organized by days to expiration, and I pretty much know. I mean, I've got like weekly trades that I put on, and I'm looking at those. Obviously, if I'm doing any 0 DTE trades, then I put those on right at market open. I usually look at them pre-market. I mean, my pre-market actually starts the night before I go to bed. I'm looking at pre-market before I go to sleep. I'm usually up, you know, sometimes an hour, sometimes 2 hours before market open. Sometimes I miss market open. I actually don't set an alarm. Market opens for 6:30 in the morning here. Many times I'm up around 4:30 or 5. But if I'm not, and if I sleep until 7, it doesn't matter. I'm not, you know, that doesn't make much difference. I'm not that type of trader. Everything is, the bulk of my money is in monthly trades. I'm dealing with them 3 weeks before expiration. There's only small amounts of money on my weekly trades. So my morning routine is look at it. You know, obviously my morning is usually filled with emails more than anything, and responding to people, getting the chat room going, talking about things. You know, I'm a one-man show, so I have tons of emails that I just sending to people in the morning, and that's usually when I'm getting that done. And then I start to go through my trades in the first hour of the market open usually, and anything weekly I'm rolling out, and then I'm just assessing extrinsic value on my weekly rolls. That's really what I'm doing. I'm looking and saying, when is it time to roll? That's really all that's important to me. And then from a new trade perspective, it really depends on what I've taken off. So I typically trade the same stocks over and over again. And what I've done is I've developed a whole bunch of strategies. So I don't need to like wait for opportunity anymore. If I take off, you know, a scorpion and I'm bullish and I want to put on a marauder, I just do. I can just pick and choose. I can literally trade any stock anytime, just apply the correct strategy. Low IV, high IV doesn't matter to me. And it's taken me almost a decade to get to the point where I can do that, but it is a fantastic place to be. So when I take off trades, I'm immediately swapping on to a new trade on the same underlyings over and over again. Yeah, and then I stop and have a coffee, go for a walk, the usual, enjoy part of my day, come back, answer questions in my chat room, go for a bike if it's nice, hit the pool, those kind of things. Like I'm not just like glued to the screen. Nobody's trading should be like that. When I did that, I never made enough money. Like I made no more money doing that than when I took time away from the screen. So Ash, currently holding broken with butterfly put October 21st, 200, 205, 190, break even 197. Little worried. Earnings on October 19th. May I know your opinion? Thanks a lot. Yeah, that's a tough one. It's a small trade. I don't know how big your account is, but the trade is, earnings on Tesla are going to be interesting, right? Like anytime we trade earnings, it's a good idea to have limited loss strategies in play. And stock is really coming down. I played this the other day. I wanted it to come down to 225, and then it just didn't break down quite as much as I wanted before my little weekly trade closed. And so now it's broken into that profitable zone. So I think that this move was expected. I personally believe we'll see some resistance around the 200. This Bollinger Band that's approaching up while this is going down. I mean, this is becoming a very, very wide range, and Tesla's a tough little trade. When I'm in that situation, if I'm worried, then I take off some of my contracts. I reduce my size. So if I've played multiple contracts, I reduce size. If I have only played a single contract, then obviously the risk is small. I was happy to take that risk. And being that it is a broken wing butterfly, you actually make the most profit if the stock is trading at 200. So you're getting closer and closer. This is what you wanted to happen. Earnings is gonna mess with that, and it does become an earnings play, and it's gonna be tough. It's gonna be one way or the other. It's either a winner or a loser. So hopefully open it for a credit. And if case, then, the break even's 197. So it's got a large profitable range, that trade. Really it comes down to sizing. Fred says, appreciate, rolled my 75 put into AMD to next year in April because my margin's getting crazy in a small account. As you said, I left another 50 strike put open to get the stock if it reaches there. That is one way to defend it for sure. And I talked about that. The other thing to consider with positions when I have a short put that I'm trying to defend is, what am I trying to do here? I feel like I'm trying to push a button, reaching forward. When I'm trying to defend a short put, another way to defend it is actually to defend it with a ratio spread, a put ratio spread, because that way if the stock drops, then I'm getting an even further break even, and there becomes a little flat spot in my profit profile. So instead of it just being like a straight down and then adding, another straight down that's steeper, I'm actually straight down, flat, and then down. So put ratio spreads to add to a short put that's been tested. Jessica, I don't know if there will be time today, but I've been wondering about selling 2 calls against 100 share. Could you talk about the reasoning behind that instead of just 1 call? I think I already covered that in this. So if you didn't watch it, we did it there on CAT. I kind of showed it off, but basically the reason is because I'm getting a lower break even. So if we just look at 1 call, like let's just say this is 2, and you can see my break even right here is 172. This is what we're looking at, 172, 195. As soon as I take off that second call, I have no upside risk. You can see my profit profile is now max profit if the stock goes up. But the break even here is now higher at 173.85. And so by not selling this, I'm not getting that extra $1.85. And the reality of the situation is that when we scroll way out, like when we look at this, like, do I think that the stock is going to trade at $300? That's kind of that's the logic behind it. So $300, and let's look at Cat's chart. So if I was to put on a trade, And this is, this is one of the things about being an option trader is all of a sudden I can pick and choose. But here's 300. Like, is there any expectation or chance or thought in my mind that in the next week, Cat is going to do that? Seeing how earnings are coming up the 27th, what is the likelihood of that happening? Well, the likelihood in my mind is next to zero. So when I'm building out a profit chart in my brokerage or in my comparison calculator online why do I need to make a profit if the stock's trading at 300? It just logically, it doesn't make any sense to me. So what I want to do is figure out where this is that it is logical that it would trade. And then I'm going to add risk because I know that there's a trade-off. If I add risk to this side, I get to decrease the risk on this side. And whether or not it's worth it is the choice, really. Is $20 of risk reduction on the downside worth the profit cap at 200? The likelihood is there's only a 5.9% chance that it's going to trade above $200, but I'm also only giving myself 25 bucks. It may not be worth it. What I typically do is I sell a little more aggressively. So, and then if I want to shift this risk profile, I just buy more shares. So in this case, if I've got 100 shares, my risk profile, let's just zoom in just slightly here. So it's a little more clear. There's the risk profile of 100 shares. Well, if I increase this to 110 shares, let's just say I change this to 110, then it's going to adjust. It's going to shift this a little bit. Now it's a little sloped, and I can do this pretty easily. It doesn't have to be a full lot. I can now have 125 shares, and now all of a sudden it makes more sense. Like I'm going to lose money if the stock goes to 300, but this is why I might trade in this way. I might start to use these two calls to generate greater theta decay, more cash flow in my account, use that cash flow to buy stock at these low valuations. This is one of the primary things that I'm doing right now. Every 100 share stock position that I have is increasing incrementally because every time I roll these for cash, I'm immediately putting that cash to work and putting it back into the stocks. I hope that answers that question. Thanks for the support, by the way, Anne. I love that you're a supporter. Been around now a couple months. You're silver. You've got the silver shield in the chat, which is awesome. So appreciate that. Foyed appreciate rolled. Yeah, we talked about that. Jessica, sorry, that was Jessica that I was answering for. Jessica, appreciate you as well. You guys are great. Love that you're here as part of the live stream. Amazing. And Aspen Pilot gives me the thumbs up, which is great. Thank you, Aspen Pilot, for being a longtime patron. Appreciate it very much. You guys are great. I'm going to chat more with you in the chat room, which I'm going to zip over to. It's 12:37. Looks like my day trade is working out pretty nicely. I'm going to be able to close that for a nice little credit, which is great. And I'm just trying to close that window, but I can't. You guys are awesome. Thank you so much. Let's get rich together. Where's that button? And I will see my patrons on Thursday. I'm going to try to squeeze in a little public stream Thursday prior to the patrons only stream. So watch for that. 11 o'clock Thursday. We'll do like 10-minute quick little market recap. You guys are great. Thank you so much. Take care. Bye.